Hey, good evening, everyone, and welcome to tonight's live stream. Hope you're having a fantastic evening, a great day. Please let me know if you can hear this in the stream. Just go ahead and give me a thumbs up or hit a yes there on the comments in the chat section, and I'd be happy to adjust the microphone or anything else we need to do. We are going to be talking today about tax-free savings accounts, 10 TFSA mistakes you must avoid. Some of these are going to be probably you're aware of them already, and then there are going to be others where you're not aware of those, and you're going to be grateful that you tuned in today to this session. If you're new to this channel, my name is David Aaron of Aaron Wealth Management, and I do live streaming on Wednesday evening at 7 o'clock, and then I put a whole bunch of videos up on YouTube for you to be able to enjoy learning about everything: retirement planning, estate planning, tax savings, for business owners, how to use your money in a different way, in a way that you can take money out of your company without paying any income tax. I help you see how to protect yourself against losing your lifetime capital gains exemption, which is almost $900,000. So it's a big deal when we start talking about corporate structure. But today, and also I'm life licensed, so I do a lot of life insurance with my clients as well. So today we're going to be looking at 10 mistakes you want to avoid in your tax-free savings account. So why don't we just get right into that? Some of these things I'm going to be putting up on the screen so you can kind of get a better illustration, and others I'll just be talking to you about how these things work. So one of the things I'm going to share with you right now is just sort of the agenda. So what you're going to be learning is the differences between having a named beneficiary or having a successor holder. What is the rules around naming beneficiaries and successor holders in a tax-free savings account, the dangers of naming either a beneficiary or a successor holder, especially if you have a will. How do tax-free savings accounts get taxed at death, which is kind of interesting because people think, hey, wait a minute, this is a tax-free savings account. How tax-free savings account work when your spouse is named as a beneficiary and your spouse passes away. What are the tax consequences? How do the TFSAs move to your beneficiaries when that happens? Are tax-free savings accounts subject to probation and so on? So I'm going to get into a lot of details and some of those big things you really want to avoid. If you have any questions during our live stream, please just remember to go ahead and put all your questions in the comments below. This is streaming across LinkedIn, Facebook, and YouTube right now simultaneously. So anyone on any one of those platforms, if you want to put your comments in the chat, I'll be able to see those and respond to any of your questions as we go through this on the fly. Okay? Wonderful. Let's move on to just a quick update, refresher on what's a tax-free savings account. For anyone that doesn't know, we'll just talk about that. So tax-free savings account were introduced in 2009. They're originally used or marketed as a high-interest savings account by the banks. They did such a great job of saying you should put your money in here, high interest savings, and you won't be taxed on that. And they did such a good job that people today think you put, your high interest savings or GICs, and that's the only thing you can invest in. I'm going to share with you actually what you can invest in. So that's actually one of the big mistakes in tax-free savings account. Anyone who is 18 years of age, actually the age is different depending on what province you are in, but for the moment, we're only going to talk about Ontario for today, okay? But any resident who is 18 years of age or older is welcome to open a tax-free savings account. The maximum contribution that you can have or you can do in your tax-free savings account every year is $6,000. Now, up to 2021, $75,500. So this is a cumulative, very much in the same way your RSP has a cumulative effect. If you don't contribute to your RSP, that contribution room remains there and you can use it at a later date. Same with the tax-free savings account. The amounts that were the annual contribution amounts changed since 2009 to 2021. It will remain the same for 2022, which is $6,000. So if you added up all those years from 2009 to 2021, the maximum contribution is $75,500. Of course, if you add the $6,000 to that for 2022, it's $81,500. Now, let's get into the first, make sure there's no questions here. Fantastic. Let's get into the first mistake, and that is around beneficiaries and successor holders. And a lot of people have some confusion about what is the difference between the two. And this is going to be really easy. I'll share this with you. A beneficiary is someone that you name, and it can be anybody that you want to name. It doesn't have to be a spouse. It can be anyone. A beneficiary receives the proceeds of your tax-free savings account on the time of your death, receives the proceeds of that, and it's given to them in the form of a check, if you will. It's not something that they automatically just take over. As a beneficiary, that amount of money would be basically transferred via a check to that individual. Now, if you have room, so let's say you are the beneficiary of a tax-free savings account, and if you have room, if you're older than 18 and you have room in your tax-free savings account, you can take whatever amount that you've received and you can fill up your unused contribution room of your own TFSA. The remaining amount would have to stay outside of the tax-free savings account, and presumably you would either pay off debts or you would invest that money, but that would be fully taxable. So that's a beneficiary. Now, if you're named as a successor, now this is slightly different. A successor essentially takes over your tax-free savings account at your passing. So you own a tax-free savings account. Let's say you've named your spouse, we'll call it, as a successor holder. At your passing, on the date of your passing, your successor holder, who you've named, your spouse in this case, actually it becomes theirs. So it's almost as though they're putting your name on your deceased spouse's tax-free savings account, or they can have that amount of money transferred into their tax-free savings account. So there's a big benefit here. When the amount is transferred, at being a successor holder, when the amount is transferred into your tax-free savings account, it's not considered a deposit, meaning it takes up your unused contribution room. If let's say you had $1 in your tax-free savings account and you're named as a successor holder, and there was $100,000 in that particular tax-free savings account, you could have that amount transferred into your tax-free savings account, and you would still maintain your unused contribution room. So there's a really clear advantage here in being named a successor holder versus being a named beneficiary. Does everyone understand that? If you don't understand that, just put a question there in the comments, and I'm happy to try to explain it a different way. But it's fairly simple. And so you don't need, the key here is you don't need any extra contribution room in order to move that money over into your account. Now, what if you're named? So what if your spouse is named as a beneficiary in the account, right? Or sorry, what if you name a successor holder and a beneficiary? So sometimes we see accounts where we see that the spouse has been named the successor holder and the children are the beneficiaries. Now, why would somebody do that? And who's in the first position, basically? So the successor holder is always in first position. So let's say a husband has a tax-free saving account and his spouse is named as a successor holder. On the husband's passing, the surviving spouse takes over that account. But what if that spouse also dies? So think of terrible tragedies like car crash and both parents have passed away. then the beneficiary now comes into first position. So the successor holder has passed. Now the 2 beneficiaries, 3 beneficiaries, how many beneficiaries you've named, now inherit that money. Now remember, they're not successor holders, they're beneficiaries. So that amount of money doesn't get automatically transferred into their tax-free savings account. It would be basically a check would be cut and given to those beneficiaries. So that would be a situation where you've named a successor holder and you've named a beneficiary. All clear? Clear as mud so far? Okay. Now, one of the other areas around, or mistakes, if you will, we can call this mistake number 2 out of 10, is underinvesting in a tax-free savings account. Earlier, I mentioned how the banks did such a great job of marketing tax-free savings accounts as high-interest savings accounts that so many people just kept their money in high-interest savings accounts. And that's not the case. Or they just put GICs. You can invest inside of a tax-free savings account in almost anything, very similar to what you might invest in an RSP or a non-registered account. So you can put stocks and bonds and mutual funds and segregated funds, GICs. You can do all of that inside of a tax-free savings account. So the second mistake is thinking that it can only be treated as a high-interest savings account, which is not true. Now, the third mistake that people do with tax-free savings account, I see this all the time, and that is, especially now, maybe not now, maybe the last decade, where we see the stock market values just going through the roof. And this year, last year, rates of return in double digits. Easily, people are getting 15, 25, 30% rate of return in some of their investment accounts if they have the risk tolerance for that. And so you think, well, why would I pay down debt first if I can get this in the market? Well, because you have no way of knowing for sure if those rates of return are going to continue. And it's a smart thing to do is while you've got the capital to pay down your debt. So it doesn't make any sense really to have, let's say, a credit card debt at 19% and you try to invest at the same time. You really want to first pay down your high interest debt first before you decide to start investing. Now, one of the side benefits, if we use the example of high interest credit cards, and that is, well, making payments on time is always a good thing, right, to keep your credit score. But your credit score actually will improve if you keep your balance in less than 10% of the available credit limit. So instead of letting that credit keep at the same level, you might as well just start to attack that 19%, get rid of it. And the other thing I want you to consider is I want you to think of 19% interest credit cards. I want you to think of when you pay off that card or pay it down, you're saving 19%. Think of it as a rate of return, that you earned 19% for paying that off, because otherwise that would have been the charge to you. So I'd rather earn 19% by simply making a bill payment than keeping my money in a credit card. Does that make sense? I hope it makes sense. If you like that, give me a thumbs up, and I'd appreciate all your feedback. Rosemary, hey, Rosemary, nice to see you on the call. Let me just see your question. I'm going to show this one, okay, Rosemary, so everybody can see. If I take out $10,000 before December 31st, can I recontribute the same amount, $10,000 next year plus the $2,000? Good question, Rosemary. In fact, actually, it's one of the items I'm going to cover in just a few seconds, or a few minutes. So you're going to see that's one of the things I do talk about. So, but great question, and I see where you're going with this, and I'll answer that in just a minute. Okay, mistake number 4: contributing and withdrawing. So we're getting close to that, Rosemary, that question. Okay, the annual contribution for a tax-free savings account is $6,000 annually, up to a limit for 2021, $75,500. So what does that mean in contributions and withdrawals? And to Rosemary's question, because this slide and the next are really about that, Rosemary. Let's say you have, and this might be better if I put this up on the screen so everybody can see this graphic. Holy cow, Rosemary, were you like looking over my shoulder when I was preparing the slides? Because I used $10,000 as the example. Well, okay. In this example, we've got a tax-free savings account balance of $100,000. So we're presuming that this person has deposited $75,500 and it's earned a rate of return. It's now grown to $100,000. So you get that so far, right? It's like they have no unused contribution room. They've completely filled up. That means they also use their 2021 annual deposit of $6,000. They put that in there as well. So they've made their deposit for 2021 of $6,000. Now, look, they might have, in this case, it's not like they put in 75,500 last week. You know, the balance is now $100,000. But even still, let's say they deposited $75,500 January 1st because they had never had a tax-free savings account, and they decided to open one up and deposit that money. And now it's grown to $100,000. So you get the meaning here. They have no unused contribution room. And they make a withdrawal of $10,000 this year. Okay. So to your question, Rosemary, here's that $10,000 withdrawal. So the question is, and I'll put this out to everybody, can they contribute? So let's say yesterday I withdrawed the $10,000. And then I changed my mind and I want to put it back in. Can I put the $10,000 back in tomorrow or anytime this year? I'll just wait a second to see what your answers are. If you've got any, I'd love to hear what you think about that. It's not a trick question because this is where people get confused all the time. They've contributed their maximum contributions for the year. They have no unused contribution room left. And they withdraw $10,000 at some point this year. And now I've got that $10,000 and they say, you know what? I'm going to put it back in. Can I do that? The answer is no, you cannot. You can only deposit $6,000 per year up to your unused contribution room. Okay, so I have no more unused contribution room and I did my deposit, so I have no more room. Rosemary gets the prize. You're right, Rosemary. You have to wait until next year. Well, the answer was on the screen all this time. It's not like, right? I should have made that part disappear. The answer is no, you got to wait till next year in 2022, January 1st, when you can put in that year's unused contribution room of $6,000 plus the $10,000 that you took out in 2021. Okay, so you have to wait the following year before you can recontribute the $10,000 you took out this year. Great question, Rosemary. I'm glad you're participating in this, and thanks very much for tuning in again today. Okay, so let's talk about mistake number 5. And we can call this mistake because it's not so much a mistake, but in terms of future planning, okay? Let's say that you wanted to make a purchase. Let's say it was Lindsay Lohan's NFT called Lightning, and you wanted to buy her non-fundable token. That's that drawing that she did to the right there. And you wanted to buy that for $50,000. Why am I saying $50,000? Because somebody bought that NFT from Lindsay Lohan for $50,000 in an auction. I think it was about a week ago. So let's say you were thinking there's an auction coming up and I want to buy an NFT, and I decide that I want to buy that, and I take out the money out of my tax-free savings account next year because the auction, let's say, is in February of 2022. So I do a withdrawal of $50,000 and I buy that NFT, and then I sell it and I make $70,000. And now I want to put that $50,000 back. Well, I can't because the maximum contribution is only $6,000. So if you're thinking you're going to want to use some money in the first quarter, first half, we'll say, of 2022 or the next year, depending on when you're watching this video, then take out the money now and have it available so that when you buy whatever it is you want to buy, and you want to, if you end up having the money to recontribute, you're able to recontribute because you took the money out in the previous year. So in this particular example, I would take the $50,000 from my tax-free savings account now, or at least before the end of the year. And then if I want to buy Lindsay Lohan's NFT, then I buy it and maybe I sell it, try to flip it, and I get that money back, and I can immediately fill up my tax-free savings account again with that $50,000 that I withdrew. Does that make sense? I hope so. Okay, moving on. Retirement planning. I see very early in when tax-free savings accounts came into play that people really undervalued the use of a tax-free savings account. You can imagine that when these first came out in 2009, people said, "What am I going to do with this money? Like, it's such a small amount of money. How would that help me in retirement? It's not going to do anything for me." Well, cumulative, now people look at that and go, "Gee whiz, $75,500 per person, a couple, that's a times two for a couple. That's a lot of money for us to have when we reach retirement." So I want you to think of the retirement phases that people go through when you come into retirement, especially, and I'll put it up. This will be made available on the YouTube video, but what we're really talking about here is the use of money in retirement. So what accounts do you pull from to supply yourself with your income that you need in retirement? And so an easy way for me to help you with this is, let's say you retired at age 63 and you weren't going to start receiving your Canada pension plan and obviously your old age security until age 65. And maybe you also you're a teacher and you had a pension plan and you weren't going to receive that till age 65. And you stopped working at age 63. So for that 2-year gap, where do you get the income to live? That's really the purpose of a tax-free savings account in that particular situation, because you can not have to worry about RSPs, Canada pension, old age security, or your defined benefit pension plan until age 65. You can leave those alone, and you could tap into your tax-free savings account and use that to supply yourself an income, tax-free income, in retirement. So that would be an ideal case for the tax-free savings account. So it's a it doesn't have to be that way. You can use your tax-free savings account right through your entire retirement. But those 2 years, that's a good way for me to explain to you how useful that is, because it fills in the gap before you actually start receiving the majority of your income, which is fully taxable at that time. Does that make sense? Okay. The next situation is marriage breakdown. We see this sometimes in marriage breakdown when people are getting a divorce and has to be like an equalization, or there's a decree or an order or a judgment where one spouse has to pay the other. A nasty thing to do would be for one spouse to do a withdrawal, so a cash withdrawal out of their tax-free savings account, write a check and hand it to the ex-spouse. That would be nasty, because that ex-spouse now, if they had no room in their tax-free savings account, they'd have to put that somewhere where that would be fully taxable, or pay down a debt with it or something. But in essence, you're moving it from a tax-free savings account from one spouse. Remember, they were both married. They both had tax advantage positions that they both benefited from. And the one spouse then withdraws out of the tax-free savings account. He doesn't have to pay any tax. She doesn't have to pay any tax, but and gives it to the other spouse. And now it's in a position where it's fully taxable. It's kind of not fair, right? So the way that you want to do this is by transferring it directly from your one spouse to the other spouse during a divorce, so that that money goes directly into the receiving spouse's tax-free savings account, and it doesn't mess around with their contribution room. So it doesn't fill up their contribution room. This is really important, because otherwise you're going to have something you'll have to begin paying tax on. And the benefit here is that the money now is sheltered inside the tax-free savings account. So remember, and this is an important lesson to learn, because there's so many divorces, so many marriages end in divorces, that this is how you ought to transfer assets during a divorce, is directly from one spouse to another. There's a form for it. And if your lawyer doesn't know about it, they ought to, but that's why you should always consult with a financial advisor, even when you're getting a divorce, because it's very important. Rosemary, if you require, here's another question from Rosemary. if you require before 65, so if you require the tax-free savings account, if you retire before 65, is it better to withdraw from your RSP or TFSA until you collect CPP and old age security? Well, Rosemary, that is a very good question. And I've actually got a couple of videos. Actually, I think I've got 4 videos on YouTube about that very subject. And it's not that I don't want to answer your question. It's just that's a very individual, personal question to answer. So why you would say, like, should you take your tax-free savings account? The answer is you'd have to go through someone's financial plan to see what their financial position is and how much income they need. What are their sources of income? These things are very, very important. So I wouldn't say, so to give you an example, some financial plans that I've done where the tax-free savings account is dipped into every year and it goes for several years until it's gone. Wow. There are other sources of income. And then there are financial plans where it is the only source of income because we're trying to defer much of the income that they would receive, which would be taxable. So they're using their tax-free savings accounts first. So in each person has a different situation. And so I look at that individually. And when I'm doing a financial plan, I run several illustrations to compare what would happen if you use all your tax-free savings accounts right away versus riffing right away. So taking your RSPs and riffing them right away. I run a number of different scenarios so we can see exactly what kind of income is happening for that particular person or couple, including what kind of tax rates, how much taxes they're going to pay, how long their incomes will last throughout retirement. So to answer your question, it's difficult to answer that question without doing one specifically. You can check. I can't point to one right here, but if you go on my YouTube channel, I think there are like 4 videos that talk about CPP, old age security, when to take CPP, the crossover or break-even point for taking CPP, and what kind of how a financial plan helps you in retirement. So there's like several videos there. But if you have any questions, if you want to go through that one-on-one, just contact me directly, and I'll help you with that. Okay. Number 8, we're almost there. My goodness, we're zipping through this. What happens if when a beneficiary, you've named a beneficiary, let's say it's a spouse is the beneficiary, and the beneficiary dies. And so people remember when in the very beginning we talked about the differences between a beneficiary and a successor holder. So in a tax-free savings account, if you've named your spouse a beneficiary, you would think, oh, they're going to get a check, right? Well, that actually happens. So there's a check being cut and being given to that. So it's actually being withdrawn out of the tax-free savings account, and lump sum is being presented to the surviving spouse. But the survivor, we'll call it the beneficiary, if it's a spouse, is actually called a survivor by CRA. And survivors have benefits under the tax law in Canada when inheriting assets from your spouse. So in this one particular situation, even though you haven't named a successor holder, the beneficiary, if it's a spouse, is able to take that amount of money and deposit it into their tax-free savings account so that it's almost like a successor kind of relationship. And so here's how this would work. So let's say the owner of a tax-free savings account, a spouse, passes away and they name their spouse a beneficiary. Then at the day of their death, the amount of the tax-free savings account, the fair market value of the tax-free savings account is then makes up how much money would be able to be contributed to that the surviving spouse's tax-free savings account, even though they were only called a beneficiary. And any excess amount, now an excess amount could be, now this is part of what happens to tax-free savings account. Is tax actually applicable to a tax-free savings account? Can a tax-free savings account be a taxable event? And this is where it can be. So someone passes away, a spouse, the beneficiary is the spouse, and that person is really now a survivor. That amount of money that they are going to inherit as a beneficiary, that check, they can now deposit that into their own tax-free savings account. But what happens if there's a delay in the process of doing that? What if there is some kind of dispute, somebody disputes the will, and they can't wrap up the estate right away? And so that amount of money is just sitting there and it's earning money, hopefully earning money. But the sticky point here is let's say the person is the surviving spouse is named Bill. Bill is going to inherit that tax-free savings account from the spouse, but they can't because somebody or some group of people are disputing the will. And so that money is sitting, earning some money, but it's still designated Bill's. And so what happens is that amount of money above the fair market value, what it's earned, is now fully taxable in Bill's hands. So there's an interest for the executor to wrap up the estate as soon as possible so that there's no issue of having to worry about the estate having someone who's inheriting some money to pay a tax. I've seen it in mitigating some estates where it's become ugly, where it's taken 5 years to wrap up an estate, and the beneficiaries were all subject to having to pay tax on some of the cash they were receiving. So I don't want to get into the nitty-gritty of what happens in that case, but in that one particular case, the executor ended up paying the tax on behalf of those beneficiaries. Whether or not that's a legal thing to do, I think it was legal. But typically, or what they might do is they'll pay an extra amount, which is unfair, to pay an extra amount to the beneficiary so that they can pay the tax. And the problem here is equalization, right? Depending on the beneficiaries and all their own individual tax rates, one is going to have to, if they're all paid $10,000, and they only had to, like 7,000 was supposed to go to them, and they give them an extra 3. Let's just say, for example. Well, depending on the tax rates, some might end up netting more than the other beneficiaries, which would be unfair. So you can see how it gets messy. So it is within the interest of the executor to wrap up the estate as soon as possible, so they don't have to worry about these things. So you can see that there's the main difference here between a beneficiary and a successor is that being named a successor, the amount of money, you don't have to worry about a check being cut and then possibly having a delay. Even if there was a delay, like somebody was disputing the will, even if there was a delay, the entire amount, even the accrued amount for the successor, would be dumped into their tax-free savings account without any tax disposition on their hands to worry about. So successor first, then beneficiaries, but there is a backdoor for the beneficiaries to accommodate them if you can get it done fairly quickly. Okay, now, and by the way, you have to do that within 30 days of the deposit. So imagine again, Bill is the beneficiary. Bill then takes that check and deposits it to his tax-free savings account, and then fills out a form. It's actually called RC 240, designation of an exempt contribution for a tax-free savings account. You fill this form in, send it to CRA within 30 days, and then they will not count that as a contribution to your, so they don't remove the contribution from your tax-free savings account. Okay, I think this is 10. This is a biggie, and everybody asks me this question all the time, and that is, can I be taxed if I'm using my tax-free savings account and I'm day trading? And the answer to that question is maybe. So if CRA, this is sort of like a gray area for CRA to be able to say, yeah, we think you're running a business here. If you're using a tax-free savings account to do some trading, securities, so day trading, so to speak, and they think the volume of trades that you're doing is so high that it becomes a business where it becomes your source of income, then they're actually going to say that is wrong. And what they call it is being really, they're penalizing you for this. So what they're saying is gains from the sale of investments will not be treated as a capital gain, but which would be 50%, right? But they'll be treated as income, and that's 100% taxed, right? So there's no preferential treatment here. So you're getting the 50, that full tax plus your personal tax. There's actually it's a big problem, and some people are using tax-free savings accounts to trade, and because of the volume of trades and the amount of money that's being accumulated in a tax-free savings account, Revenue Canada, in their purview, can look at that and say, we think that's a business you're running, and it's no longer going to be sheltered inside of a tax-free savings account. You'll be fully responsible for the taxation. So bad news on the part of that. So if the rule, so I guess the rule here is, if you want to use your tax-free savings account and you happen to be trading, just be careful and do it in moderation. Okay, remember, if you like what you're seeing today and the kind of information that I've been putting forward, please comment below, share it with everybody else, like and share. If you're new to this channel, subscribe to our channel. And you might be saying, subscribe, I'm watching this on LinkedIn or on Facebook. Well, I actually have a YouTube account as well. So please head on over to my YouTube account and subscribe to that channel. I upload 1 to 2 new videos per week, plus the live stream on Wednesday evenings at 7 o'clock. I hope you enjoyed tonight's topic on tax-free savings account. I like to end all of my videos by telling people that we take care of your wealth management so you can take care of what's most important to you. I truly believe that in my heart. I think it's so important that, you know, the quality of your time and your relationships are always more important than the money that you have invested. It's really important that you spend time with the people you love and care about, and let a professional manage your money. Hey, Pascal, nice to see you. Hope you're doing well. Looking forward to talking with you very shortly. There's my contact information right there. Again, everybody, thanks so much for tuning in tonight, and look forward to seeing a couple videos post in the next few days on my YouTube account. If you're on LinkedIn watching this, these videos are only there for 2 weeks, and then they're taken off of LinkedIn, so they're permanently placed on YouTube. Thanks again for tuning in, and I look forward to seeing you again soon. Take care.